Usman, how are you this afternoon?
I'm doing well, thank you. How are you doing? It's good to be here.
Yeah, I'm glad you carved some time out of your calendar. I've been really enjoying your writings on LinkedIn, and now you have the frame break kind of
Yeah,
newsletter. Yeah,
right.
which I think is excellent. And you write a lot about the professional services industry, which law firms are a part of that. Little bit of a different angle. But before we get into all of that, let's get you introduced. So I found you on LinkedIn. You had a really interesting article about a blueprint towards a future state in professional services, and
Right.
yeah, we'll dive into that. But you are managing director of High Output Ventures. Tell us a little bit more about kind of your background and what you're doing
Yeah,
today.
for sure. Um, well, I started my path of entrepreneurship started 2003. So that's when I set up my first company while I was in college, and 22 years later, here I am. And the career has sort of like gone through multiple sort of like cycles and industries, whereby I initially started off with print design and graphic design. Then we went into advertising with a firm that I ran called Hatch Media. We sold that in 2010, got into tech, HR tech specifically around performance management software for large MNCs. 2015-16, got into the crypto space very early with a company called Alt Manager to help traders trade and execute on the exchanges right in the early days of Ethereum. Um, we exited that business 2017, and then since 2018, I was primarily involved in the technology uh, VC investing space. Primarily investing in South Asia and Southeast Asia as focus, with core verticals that we were really focusing on were e-commerce. So e-commerce was what I was focusing on, a bit of SaaS in the spaces that we knew. And that I did till around 2022, which is when valuation started to go completely out of whack during that period. And I started looking at services businesses as avenues for, alternative investing. And instead of betting on the gold rush, sell the picks and shovels sort of like technique was the way. I had built up the capabilities of outsourcing in Philippines quite a bit. So it was like, okay, so we have the capability of spinning up quite a lot of people in the Philippines. So how do we leverage that? And we did a bunch of development studios, design studios. And then around 18 months ago, I got involved in a private equity fund, which was doing accounting firm roll ups, which is when I got very close to the professional services space and discovered how many of these firms, which were built for human leverage, were struggling with this shift towards the technology leverage era that we're entering, and the opportunities that it was creating. And that led me down a rabbit hole. And since the start of the year, I've been writing about the space, learning about the space, connecting with lots of people in the space as we navigate. And the goal being to ideally come up with a playbook for what services or software could sort of like look like for startups and new firms, and then perhaps a fund around that, which would focus squarely on what I'm calling NewCo companies doing the services software play. So that's a quick round of how I got here.
Okay, yeah, super interesting. And you have highlighted some of the challenges with the partnership model, with internal firm compensation models, with, and this is really outside of law, but many of these things apply. Consensus driven decision making, legacy commitments for, retirement,
Right.
all of those sorts of things that also perm, um, exist, I would say, in the legal world. And I see the biggest challenge from us getting to current state to future state is is multifaceted. But if I look at where I see the most friction, it's around culture. And
Right.
one thing I think that the big four have that law firms don't is innovation is really baked into their DNA, and
Right.
it's not illegal. In fact, I would say that it's probably close to last on the list in terms of innovation, and that is changing rapidly now because there's a gun. The law firms are staring down the barrel of a gun with
Right.
clients with their finger on the trigger saying, change, I want better, faster, cheaper, or I pull this trigger. So that's what's driving the motivation to actually make some changes here. But how do you see, like, what are the barriers in the professional services world that you think provide the most friction from where we are now to where we're ultimately going to be?
Yeah. I think when we zoom out, it was interesting what you said about Big Law sort of not having the same pressures of, let's say, Big Four, because there was a type of work that they did. Like when I think about the Big Four and all of their auditing departments, those departments have stayed relatively the same and still do the same work year in and year out. And it's a pretty profitable business for all of them, which is why, divestors have been difficult with it, even though it creates a lot of compliance and regulation problems within the consulting divisions because of conflict. But I think like I see law perhaps a lot more like the auditing part of work where it's very structured and you know what you're going to get. Here's the contract for a partnership agreement, a sale agreement, whatever it may be. I think it's well defined. The other parts of the Big Four, as they sort of like rotated back into consulting by acquiring a lot of their capability after the Enron divestors that they had to do, was that those parts of the business were always dependent on the market and how the market was changing, because there was not one thing that they were doing, whether that was let us get you ready for the cloud, let us get you ready for the blockchain, let us get you ready for remote, like whatever the flavor of the month may be. I think they rotate onto that very quickly because there's always a gap in capabilities of what firms need to get done versus internal capability of getting done. And so they always go to these firms, and these firms have to continuously ride this information arbitrage wave because they have this expert knowledge that they either acquire or hire for internally and then provide as a service. And I think like that's perhaps the way that they've been able to evolve. And these deals have just got bigger and bigger because there's just one transformation after the next transformation that you're selling into. And the biggest thing was that outcomes have been, when you're doing $100 million transformation project, it's pretty difficult to really nail down what is the exact outcome that you want. There are probably a multitude of outcomes. And tracking has been hard, which has kept the time and materials and project and fixed price projects coming. And I think that's the challenge that I see today with both the Big Four and then law, because this information arbitrage is collapsing. You have technology which is capable of doing a lot of the grunt work that was being done before. And I think the pressure for delivering outcomes is coming from the top. So you have margin compression from the top, then you have automation compression from the bottom, sort of like eroding the base of the pyramid. And many of these firms now all of them are in the same boat. Like if your business scaled by adding more people to your organization to grow revenue, I think the public markets are voting as we see. I cover public stocks pretty much every week on Tuesday. And if you are not doing the rotation and technology leverage, the market just keeps punishing you quarter after quarter because they're like, I don't believe that this is sustainable. And I think that's what truly triggers change in this. There's one, the culture aspect that you talked about, and then the second is market and economic forces forcing these companies to change. Otherwise, what will happen is that your stock continues to get destroyed, and private equity will just come in and buy your company for what it's worth, and they probably can split it up and make a lot more by doing what they do best. And I think this is where they're stuck. it's a fascinating spot to be in. But I wouldn't want to be leading a 300,000 person firm right now and saying like we're going to rotate, because I think several very difficult decisions need to be made.
Yeah. Well, law firms don't get to nearly that size or scale. The largest law firms in the world are all under 20,000 employees,
Right.
typically under five. There are a few outliers, Denton's, Kirkland and Ellis, a few others. Um, so you mentioned the market and penalizing companies for um, their people leverage. And
Right.
something popped up. I think was it Monday.com last week,
Yeah.
who got lost like, I don't know, 20%,
30%. Yeah.
30%. And that was based on a call around their SEO strategy that they seemed to not demonstrate a good level of understanding. This is me just reading articles. You may know more
Yeah.
about it, but um, apparently, the AI summaries in Google have destroyed their SEO
Right.
strategy, and they didn't seem to have the answers that investors were looking for. But that is one hell of a drop. I
Yeah.
mean, normally that's the kind of drop where there's a scandal that,
Yep.
like are we, I don't know if you know anything about that situation, but are we going to see more of this type of thing?
I'm I think Gartner was down 35% on the year as well right now. And so they released earnings and the market did not take to them very well. And because they're having other problems, like the Monday problem is customer acquisition costs will go up because SEO is just not driving as much. And so once your CAC goes up, margins get compressed. So essentially the market is saying that if this channel doesn't work for you and it's going to cost you a lot more to get your customers, I don't see you inflating margins anywhere else or making difficult decisions. And I think all these firms are getting compressed in the same way. It's either you're not rotating, or if you're a technology company and you're not figuring out how to play all of these changes, and there are just far too many changes happening. For Gartner, it's they have this very big analyst network, and they are plugged into all of these companies. They speak with all of the CEOs. But the problem that they're having is a lot of people are uploading a lot of Gartner reports straight into ChatGPT, and then when you and I sort of like query it, we get pretty close responses to it. Will we see them go towards the DRAM sort of solutions that we saw the music guys go before and say, okay, these PDFs are going to be protected? But we all know how that ended up for all the music people. Like at the end of the day, it's a cat and mouse game with these, and now they're doing Ask Gartner, which is their version of Ask Us the Question. And I think in the law space, you have LexisNexis, which also has LexisNexis AI, which is the same sort of like way to do it. And I think for all of these firms, if you rotate to subscription and a per query pricing model, then your analyst structure needs to change fundamentally, because I'm going to be calling an analyst a lot less, and I'm going to get the answer over there. So you're again peeling off revenue and margin from the top, and I think this just eats your tail from the back slowly. And the market is basically saying that they released Ask Gartner in the last call, but the market didn't buy it, and they're like, you've got to do something. But lots of people are saying that the market's overreacting right now, but when you see this part of the market and then you see the rest of the market sort of like reaching all-time highs, and tech stocks rotating to god knows what levels, uh, I'm pretty sure there will be a reversion to the mean, but unless we seen.
Yeah, it does seem like there's a bit of a jagged edge. We always talk about the jagged edge in AI capabilities, which is, I feel like, a good metaphor, but also in the market. The fact that Monday didn't have the right answers on an analyst call. I mean, you can look at ratios, you can look at CAC to LTV. I mean, there's numeric representations that show trends. I thought it was interesting, and with Gartner specifically, that's a pay to play network. Like if you want to be on their radar and be part of their research, I mean, it's close to a 6-figure investment. We've talked to them,
Right.
And I think that you're right. The level of output that you can get out of these AI models now is staggering. I've done research on my own company through it, which, you know, we're 50 employees, right? Like there's not a ton of information available. And it crawled the website, went and, you know, if you're using Gemini, it'll look at YouTube video transcripts. It has mechanisms to go out and find information, and has done surprisingly well. I've done comparisons with us against competing vendors. I've had it build go to market plans, which, you know,
Yeah.
little pieces and parts have been useful. But again, it's, if you look at the trend, like, you know, 2 years ago, what you would get out versus today is very, very different. What do you think? What is your perspective on how far AI can go with kind of the high value knowledge work? I think you had a McKinsey post and talked a little
Right.
bit about this. Like how far up the value chain do you think can it go all the way to the top? Is there going to be,
Right.
we're going to hit our heads on a
Yeah.
ceiling?
Yeah, I wrote a post which was a reaction to a pretty prominent VC saying that if he was going to start a company today, it would be McKinsey as software. And I thought it was an interesting angle that he took. It got a lot of views on X. And I wrote a post which said, okay, let's try to decompose McKinsey. And when at the core of the essence, there are a lot of tasks like analysis, pattern matching, structural analysis and problem solving, and all of these core grunt work which gets done. And I think my post argued that most of that work can be to a degree done today by the systems that we have with proper guardrails and training, equivalent to what a most juniors would produce. I think those were the top three that I did, which was analysis, pattern matching, and problem solving sort of like levels. And then there were two more levels, which were uh, political cover and plausible deniability, which I have become to appreciate a lot more of as I have talked to a lot of people on the client side as well. I think those are the parts where I don't see that much infiltration just yet because the boards, if I was speaking to a consulting firm leader at a Canadian mining firm, and he was telling me that they had spent six figures on a report, and he said like I'm pretty sure that spending some money on expert interviews and the resources that we have, I probably could have got that 200K report done for 30-40K. But he's like the chair of the meeting does not would not trust a 30 to 40K deliverable because they're like, we've always spent 200 on this. So it probably should be like, I won't trust this. And I think this is where the person in the seat matters, whereby you come in and you provide that confidence, you provide the scapegoat, you provide whatever it is to make sure a decision goes through and you do the necessary work. And then the second part, I think there was lots of articles recently about McKinsey, but one of them raised a good point that they carry so much indemnity coverage that when they make a recommendation, and let's say that it goes horribly wrong, like in the case of Purdue Pharma, like and they're on the hook for like 800 million. Well, they probably have insurance coverage that manages quite a bit of that for them. And I think clients are betting on that. So if they make a mistake, they're going to make them whole, or there's going to be some sort of like um, cover for them. And I think those are the parts. So I said I don't think McKinsey as a whole becomes software, but it's McKinsey to platform, which is what I ended it with, whereby you're still going to need human judgment and people along the way with a certain type of structure. But will you need the entire base of the pyramid? I don't think so anymore.
Yeah. And for those that don't know, with the Purdue Pharma, that was the Oxycontin scenario where McKinsey had come in and basically done kind of a go to market, I guess you would call it,
Right.
strategy that was a little bit too successful. And by a
Yep.
little bit, I mean a lot. And,
Yeah.
that's why the opioid epidemic it's gotten so much publicity. I mean, people are dying from it. So yeah, I would say that That is an interesting angle that I hadn't really considered, is that when you hire McKinsey, there is a little bit of a backstop, but those sorts of situations are rare. Like, how many times does, you know, one out of 100,000 consulting engagements end up in
Right.
some sort of a payout? But that's a really good point about there is a little bit of a backstop there.
Yeah, I think yeah, probably not completely covered, but for the people sitting on the board, I think there's A, McKinsey told us to do this. B, there is something at the back of this in case it messes up, especially with, let's say that Adobe's move from CDs to Creative Cloud was consulted on, which by a thing, and it didn't work out. Like, I don't know what the callback would that be, but I see it as just insurance, which is purely what it is. And you're paying a premium for that insurance. And sometimes these moves are extremely difficult to make without external third party. And I can see that, having spoken to a lot of clients, there is a lot of political maneuvering that needs to happen when, three board members want something and four want something else. And, how do you get everyone aligned? I think that's a skill, and most underestimate that skill. I think lawyers are very good at that skill as well, and and that's why I don't think it goes away. Now, the problem becomes is that the skill is built through reps and judgment over a period of time, and when the bottom collapses, I think that's the risk a lot of people are seeing. When I speak to leaders, there are two risks that they're seeing. One is that people just below partner are being a little more cautious about moving into the partner role nowadays. The reason is that there's a lot of pressure at the partner level these days across all firms because of what's happening in the world. And, while the last year was a good year, there's a lot of uncertainty in the next year, and Doge did not help in the beginning of this year. And so a lot of those APs are like, I don't know whether I want to go to partner yet. I would much rather have optionality as an associate partner or VP and see what other options I have, because private equity is becoming very interesting. What are all these VCs doing in this space? And so they're like, a lot of their key people are not moving up. And then the bottom, because they've cut graduate recruitment to the level that they have, and attrition at these firms still runs north of 15+%. There is a lot of culling at the bottom end of the pyramid as well, which then creates a pipeline problem to the top. And I think structurally, either that's just preparing for what the new structure will look like, which is a lot fewer people, a lot leaner structure with judgment concentrated at the top. I just hire the top 5-10% of the class, which is okay, 5% of the class. I mean, all AmLaw 200 Magic Circle firms will take that pick because they're like, we get a lot more utilization per new person coming in. And and yeah, that structurally sort of like then will have knock-on effects to the universities, the programs, everyone sort of like studying to get into these industries, because they're just going to be far fewer roles if this continues at the rate that it is.
Yeah.
The top 5-10% remains. And someone the other day said, I hope knowledge work doesn't become like professional sports where, just a few people at the top make all the money. And it's not like no one else plays basketball or no one else plays soccer. There are a lot of people who do that, but, there's a very big difference from major league players and everyone else. And could knowledge work go to that end? I don't know, but it was an interesting thought.
Yeah, I mean, that's, especially for economies like the US that's so heavily dependent. We manufacture very little here, and, so much of what we do is knowledge work these days. Before the last time that you and I spoke, we were talking a little bit about Booz Allen, and, they're a big government contractor, and the struggle with sometimes customers and the industry, in this case, consulting partners, where it's actually the customers who are holding back the firms from implementing, alternative fee structures, for example. Like, how are you seeing that in professional services broadly? Is it still, are clients still holding back, or are they more willing to experiment with new models?
Right. I I think for this one, clients. So when I speak to client side, there's very little incentive alignment for them to move away from their current way of working, because our current way allocates budgets to people who need to spend it in certain sort of like areas to get it done. And if I get a budget allocation for marketing for 500,000 and I've got to spend it in some shape or form, well, if you come to me and say like, okay, I'm going to help you with generative SEO instead of SEO now, and I'll charge you not for the time I spend, but for every person that signs up. And let's just say that every person is worth $1,000 to you, and I suddenly deliver 1,000 people to you. Like suddenly your budget's like out of whack now, because how do you fill the extra 500K that you got to pay me? There's no budget for it. And so you're like, I'll have to go to someone and then figure out how to make this deal work. But I don't get paid when this deal does 1,000 signups instead of 500 signups, because I have some target that I have to hit. And I think like it becomes so complicated because the incentive structures and the compensation structures are not aligned with this, which makes outcome-based pricing extremely difficult to do. What I'm seeing in the market right now is, though, large projects, usually these very large transformation projects, are now not being bid on like as a single project. What a lot of these firms are doing now is taking a $10 million, $50 million project and breaking it down into 5 parts. And they're doing this as risk adjustment from their part. Like they don't want to take another 50 million hit and nothing happens on their side. So they're spreading the risk. And I actually believe like this is a great opportunity for NewCos, because when you are doing $1 million engagement, it's far easier to figure out how to drive an outcome for the million that you're spending. When it's, let's say that we have to fix the data structure for a law firm, and you're like, okay, all of this is all, but we'll have to do this. We'll put Palantir in for you or whatever, and do the ontology exercises and get all the workflows done. And at the end of the day, you'll be able to do X, Y, Z. And then if they can do it, mission accomplished. But if it was part of an entire workflow transformation exercise, it's far harder to negotiate. And I think I always tell NewCos, especially in our portfolio, that the further you go away from the P&L, the harder it becomes to justify outcome-based pricing. And then you've got to figure out which budgets you're allocated towards, and then that is the limit on the upside. But I think ultimately most firms get forced into this as the market adjusts how it deals with bigger projects.
Yeah. And when we were talking last time, you also had mentioned how your perspective has evolved, I guess, from more kind of fear, uncertainty, and doubt into like hope and opportunity. Like how, what has happened or what has transpired that has really shifted your perspective on where we're going in the future?
I think, and so the death of consulting or the death of law or whatever the headlines these days are, I personally, having spoken to a lot of clients, I don't believe the profession or external counsel is going anywhere. I think it very much stays there, because people are not going to put all of this competency into their payroll because it costs too much and they don't need it all the time. So I believe it stays there. I think what is really optimistic about NewCos that I speak to these days is that the technology leverage part allows them to do so much more with so much less. When I'm talking to a firm that was doing some work with medical ambulance systems, and based on how the dispatch was being done before versus how they're doing now, and they've done this entire sort of like mapping exercise. And these are very niche sort of like areas where I'm seeing firms go in, and they're actually making tangible differences to these businesses, and that net is positive, I believe, for the space as a whole. Because I think consulting, law, whichever, has also got a pretty bad rep, because you'd never know what you're going to get, what the bill is going to be, how big the bill suddenly becomes, is it going to be worth it? And I mean, brand names get you so far, but ultimately businesses are still uh, uh, controlled by the market. I have the pressure off the market. And the market is a pretty difficult space to navigate these days with margin pressure all over, uncertainty, people pulling back budgets, people being reluctant to spend. And so I think net net, it's good for the craft of like people who could come in and deliver outcomes. So I think that's what I'm hopeful for. We move towards away from the slides into the tech and the platforms and see change happen.
Yeah, and hopefully I'll make a lot of money. What do you think? So I have a theory on what the market. So in legal, in the law firm world, it's extremely fragmented. So the AmLaw 100 revenue is about 140 billion, as you know. Deloitte's 80 plus billion at the
Right.
at the high end, and KPMG is 40 billion. If you add all the big four up, it's like 220 billion. So four firms almost double what 100 law firms are, right? So
Right.
very fragmented. I see consolidation coming, and which it's overdue. Honestly, it's not a sustainable. The AmLaw 200 is not a sustainable model, in my opinion. It has it has remained that way because of the way the law firm structures, the business structures, they're run by lawyers, and
Right.
they don't bring in professional management. They don't have a board of directors that that shareholders elect, that install management and hold them accountable. It's not a traditional governance model, and there are other scalability challenges too. It's lawyers can leave their firm and take their book of business with them, where that's not, that's much more difficult in other industries.
Right.
But the ABA rules allow that, or really require that. It's you have to operate in what's best for the client. So what I see is, I see the big firms that can actually afford to do the R&D. I don't think buying off the shelf tools is going to create differentiation. I mean, it by its definition, it's not differentiating. If you can buy it down the street and I have it, we're not different, right? But what
Right.
is different is the data that these law firms have, the collective wisdom, the documents that led to successful outcomes and are battle tested in courts of law. So I think on the big end, that they have the scale to invest um, in ways to leverage that data. I see advantages there. And on the very small end, you're able to be nimble, right? So being a challenger firm now is a really interesting dynamic. We're starting to see a few firms. There's one in New York called Crosby. They're still kind of in stealth mode, but it's a AI first law firm. And as these regulatory rules start to propagate that allow outside investment into law firms, historically that's been a walled garden. The non-lawyers can't own any piece of a law firm except in
Right.
Arizona and Utah, and I think they might have rolled that alternative business structure back. I'm not sure what the status is there. But anyway, let me get to my question, which is, I see opportunity at the high end of the scale, because again, the ability to capitalize on data, and at the small end with just being nimble and being able to try new things and experimental and move quickly. Where I see risk is in that middle.
Yeah.
And not everybody agrees with me. Some people think that the opportunity lies in the middle. Maybe they're right, but for law firms that are too big to be nimble or agile, but don't have the capital to
Yeah.
deploy, I don't know. How do you see the market? Do you one end have an advantage over the other?
Yeah. I agree with your thesis. If it's going to take, so I wrote about a Indian BPO firm a couple of weeks ago called WNS, and the firm has 1.3 billion in revenue and was growing well. Had moved 24% of billing to outcome-based billing, but they did have 60,000 employees, which was legacy that they had on their books. The firm was growing at a decent rate, and the cost or the price to play in the R&D game, like let's just say on a billion three or a billion, they have like 6 or 10% R&D allocation, which is quite a lot because they're not running on most of these operating margins. Well, their operating margin I think was close to 23-24%, but the market expects a certain type of company to maintain certain levels of margin for them to retain their share price. And I wrote an article and I said WNS hit the investment ceiling because the price to play now is so much higher for these large SIs that Capgemini bought them. They raised $4 billion in debt. They're like, okay, we'll buy you, and then we'll sort of like roll something else up, because Capgemini's book balance sheet allows for that level of debt to come in, and the deal was accretive for Capgemini as soon as they bought it. And that's a good example of middles which are stuck. But let's just say like this Crosby firm, maybe in a couple of years, it becomes a bigger firm, and your Kirkland Ellis sees this and says like, okay, cool, I think they have something interesting. But maybe Crosby can't get into the larger accounts for Fortune 100 because they don't have the relationships and things like that. And this week I'm writing all about trust infrastructure, which is, if firms do not, I think most professional services firms are, especially NewCos, discount the importance of trust in this whole selling process. And they feel like the best solution is going to get them through. It's not. Superior technology does not sort of like beat through that. Like if a trust, and tomorrow my public company, so I was trying to find a company which is in the professional services space, which had to evolve but uses trust infrastructure. There's a defense contractor called CACI. It's a pretty big American defense contractor. I think they have like $8 to $10 billion in revenue. Anyway, so in 2016, started researching the firm. They strategically bought a lot of businesses in the middle, built that trust infrastructure layer, and then they bought technology firms onto their books, fitted onto their rails. And today, like I saw their earnings was last week, 55% of revenue is now not coming from time and materials, it's coming from technology sales that are happening. And this firm has done it at this scale and size with 20,000 employees. And I thought it was like a masterclass. Like maybe I should have written it as a case study, but it's going out tomorrow as a firm which was able to do this in the public markets. And I think like that's the gap over here. Like if you have the balance sheet, you'll buy out the key people in the middle, the ones in the middle which are not investing, maximizing profit taking right now by not rotating will slowly wither away. And the bottom is like, will always be there with challenger. I think this is where the NewCo concept for me sits. And I always say that it's probably through wedges these people figure out how to maneuver upwards. Like they can't be full service law firms, right? And there was a UK firm which was, I think it was called Garfield AI or something. It was specifically a legal sort of like firm which was doing like invoice
claims,
chasers and stuff like that. Like, it was like a small wedge. Well, I said, okay, cool. It's like a nice, interesting business, but how are you sort of like embedding yourself into workflows and what's happening over there? And so that's what we're seeing at the NewCo level, which they have to figure out how can I deliver the outcome, and then how do I get the trust? And it's a challenging spot. So I with you on that. The top will hopefully sort of like pay attention to the middle and acquire their way through that. And then the bottom will just be the challengers, which is the Palantirs of the world, which come in. But people discount the fact that Palantir is over 20 years old. So it's not a NewCo. It's basically been doing this for a long time. And hopefully we're in a cycle where those cycle times are greatly accelerated, where it doesn't take 20 years to get to that spot.
Yeah. And, why aren't more firms like, so I see a real interesting scenario with valuation. So a traditional, like my wife and I own 5 gyms here in St. Louis. If we were to sell these gyms, we would get 3 to 4 times EBITDA, right? That's what a traditional business operates, sells for a multiple of EBITDA or net profit. Growing software companies sell for a multiple of revenue, 6 to 8 times revenue, right? So if you're a let's say for round numbers, you're a $100 million business and you are operating at a 20% margin, you can expect 60 to 70 million sale price, right?
Yeah.
Whereas if you're a growing software company operating at 100 million, you're going to sell for $600 to $800 million, right?
Right.
6 to 8 times revenue, and that multiple fluctuates with the market, but that's about where we are right now. So it seems like a very compelling move to try to build a tech-enabled legal service delivery mechanism and scale it. But I don't see, like, there's been in the legal market, there's been one acquisition that I know of. A client of ours, Cleary, bought a Gen AI startup called Springbok, and it seemed more like an acquihire. I mean, they were fairly small. I don't know if that they had a ton of revenue. I'm guessing. I really don't know, but it seems like there would be more kind of spin-offs, that these kind of going back to your blueprint, where take 20% of, net margin at the end of the year and allocate it towards your NewCo and start to build that over time. So as your legacy business starts to feel pressure, downward pressure on revenue, you've been funding this new business over here that potentially scales. Why aren't we seeing more companies do this?
Because partners don't want to get a 20% cut on their paycheck at the end of the year. That's why. Because if my tenure ends in 5 years, why am I funding this, which may or may not work? It's the incentive structure. I mean, we talk about partners doing that, but when Ford tried to do EVs versus, combustion, and the CEO was like, I'm going to go all EV. I'm going to be the CEO of the EV division. 18 months later, it was rolled in. I think it's very difficult because compensation and incentive structures don't allow it. I think with the way that I speak to legacy co-owners is that you've got to spin out NewCo, uh, hopefully get some alternative capital into that where you're not the sole capital. I think Volkswagen did that with Polestar, which is their EV play, and they spun it out. And over time, it wasn't the most successful deal, but that is an example of where a company said, like, I don't think that we can build EVs inside, and I don't think like you're going to build the next generation advisory firm within the existing structure, because the incentives and compensation models, like, a lot of the time I connect with very bright senior guys at these big four MBB firms, and the reason where they're leaving is that they're like, I'm doing my work so much more efficiently. I operate half the pyramid, but I get a one-off bonus, and I'm not getting compensated for the amount of value I'm bringing. So I might as well go out and bring that value somewhere else. And I think that attrition from that side, the other talent problems, I think internally they'll have to figure out how to do this. But my go-to whenever I speak to legacy core is, you got to spin out cleanly with a new entity structure,
Yes.
and do not allow, like, therefore then NewCo can attack certain deals that legacy co might be going after as well after a period of time, but that's what you ultimately want to do. Adobe trying to buy Figma and stuff like that, like, they try to do a lot of the things, but for Adobe, it was like the Photoshop file, and for Figma, it was this new way of working on a design file, which was not a file, and they had a completely different workflow and a way to structure the entire business, which means that Adobe copied them completely, but still couldn't beat Figma. And I think like that case study I did was like there. And then Shein versus Zara or Inditex. We see examples of this over and over again. I share them on Thursday. It always comes from the outside. And someone's got to just invest in it and feel like this is a great thing. If I have 5 years left as senior partner in a firm, and I'm looking at, the next 20 years, and you see this coming on the horizon, why wouldn't you put 20% of your paycheck into this? Because you could use your distribution to really blow up this firm and make it the next big thing. But, well, the market offers you 6 or 7% risk-free, and the core S500 is sort of like growing at a very decent clip. So it's opportunity cost, and it's, do I believe in this future?
Well, those yacht payments aren't going to make themselves, right?
Yep.
So, all right, yeah, we're almost out of time, but just kind of one last question because I talk about this a lot. The partnership model itself, I think, is a
Right.
huge limiter, and for the reasons that we've kind of touched on. Is there a partnership 2.0, or do we really need to ditch the partnership model as a whole and adopt a traditional C Corp structure with a traditional governance model in order to really for NewCo to scale?
Yeah, I think it's a great question. I still believe like the partnership structure, I don't have a problem with the partnership. I think what I've written is that when the size and the structure of your business outgrows the limitations of the partnership structure and the governance, that's when the problems really come. When you need consensus across hundreds of thousands of people, then you can't move fast enough. And McKinsey is trying to figure out how to do this with a advisory board, with the person who leads, and they've tried to come up with innovations within it. But maybe partnership 2.0 won't have a lot of these problems, because if that firm will have fewer people, will have technology leverage on their side, outcome-based pricing, I still think like as independent business owners, if you and I were in a business and we're 50-50 partners and we go in and we hire a few people to do the work, I still think that could work at a certain scale and size. I think once we hit a size and scale, that's where the problems really arise. But several very large, like Cargill or any of these family owned businesses, have retained structures with ownership concentrated at the top with very few people. I think it's possible. Perhaps that's what's going to go. And it sort of like lines in pretty well with knowledge work being controlled by a lot fewer people in the future. And if that works out, then that's what it looks like. We're still partnerships, because why will I, like, is it worth floating the company and getting public sort of like scrutiny when I don't need to get it? Like, I think like going public is tough. Like when I review these public professional services companies, it's tough out there. Like lots of people will be saying, like, thank God we're not public right now. And several of them are becoming targets for private equity to just take off, because they're just getting punished so much that, they've overly punished them. And now it's opportunity for private equity to make money. So it's a fascinating spot right now we're in.
Yeah, it's good stuff. Well, I really appreciate you spending a little bit of time with me here today. I know our listeners are going to be interested in hearing what you have to say. Before we jump off, though, how do folks find more about you and the writing that you do? What's the best way for them to do that?
Right. Um, Well, you can look me up on LinkedIn, where I post most of my articles, or then you can go to my website, usmansheikh.com, where you can sign up for my newsletter. It's a daily newsletter that goes out, where you can subscribe. And that's probably the best way how to keep in touch.
Okay. Yeah. And we'll include those links in the show notes. So, listen, again, you're not a legal guy, but I love this. I love the writing that you're doing in the professional services world, much of which applies to legal. So thanks for spending some time with us today.
Yeah, it was great. I look forward to doing the reverse and asking you a whole bunch of questions about AmLaw 200, because I felt like there's so much that I want to know about, like the consolidation that you mentioned
Mm-hmm.
and the opportunities over there. I saw that UDIA raised from General Catalyst like $105 million for this law firm that they're creating, where VCs are taking your playbook and saying like, let's fund the tech. And then when the tech sort of like solidifies, we'll go out and acquire the firms with debt. And that's an interesting VC angle to what you were saying as well.
Yeah, it's so in the here in the U.S. again, the ABA rules get in the way of outside investment, but there's a little bit of a workaround that just is hitting the press recently. There was a Financial Times article about a company called Burford Capital, I think, and they're essentially spinning up I don't know if it's a sister company or a subsidiary, and it's essentially an MSO, a managed services organization that does kind of the blocking and tackling. Almost in legal, we have ALSPs, which are alternative legal service providers. So it's almost ALSP type work, but the difference between an ALSP and an MSO is an MSO, a client would outsource an entire function. So, maybe it's your IP, they're going to do all of your IP work. ALSPs are very horizontal and tactical today, but there's a lot of overlap and crossing lines. And so, anytime you want to chat, I would, you're overdue for a podcast, man. Your content is phenomenal. And I don't say that often. So I would encourage folks to look you up. And if you start a podcast, I'd love to be a guest.
Sounds good, Ted. Well, thanks for having me on, and looking forward to our next chat.
All right. Take care. Thanks for listening to Legal Innovation Spotlight. If you found value in this chat, hit the subscribe button to be notified when we release new episodes. We'd also really appreciate it if you could take a moment to rate us and leave us a review wherever you're listening right now. Your feedback helps us provide you with top-notch content.